Good morning, ladies and gentlemen. Well, very little to be learned from the wrist dial. As I've said, and I continue to say it, it's going to be a long time till it gives us a buy signal. So, in the meantime, after a week in which very little moved anything at all we can do is look at the dangers ahead and try to position ourselves, or at least mentally position ourselves, for what is to come. I want to start with ITOT over government, so the totality of the bond market over the totality of the stock market, or even the other way around. And the trend is beginning to be unmistakable. I think this is funds flowing into anticipating a Trump victory. So the market is beginning to price it in. I'm not saying that it's anywhere close to being priced in. I think it's going to go a lot further if Trump wins, but let's try to examine why that would be so. So let's have a look at what the market is trying to price in and the consequences. Now, these are the main planks of the Trump policies, i.e., deregulation, which is good for the economy, increases economic activity, it's easier to do business. Tariffs, well, if nothing else, they increase the price level, they encourage domestic substitution. Now, domestic substitution is certainly not going to happen immediately. I think the tariffs, all they're going to do is increase the overall price level for a bit. And tax cuts, and those increase the immediate budget deficit. As a result of all these policies, I can only see assets flowing into equities. If you have bonds, you're getting an okayish real rate, but nothing to write home about. You're going to marginally shift some money into equities. That makes sense. Now, the things that have not been priced in, and it's very hard to price them in because we don't know whether they're going to happen, and that's why I've put the question marks, are one, will there be a shift in duration issuance? It's very hard for the Republicans to say that Yellen has been twisting and manipulating the yield curve by going and issuing short as opposed to long duration, and then maintain that policy themselves. Politicians all the time, they say that someone's doing something wrong and bad, and then they maintain it when they come into power. So that isn't what really worries me. What would worry me is a continuation of the current issuance policy far into the future, because I think whoever wins the election, eventually they're going to have to stop this, I won't say manipulation of the yield curve, because that's not exactly what it is, but eventually they will have to issue longer term, otherwise the average duration of the issuance falls to ridiculously low levels, and the US becomes some sort of a banana republic, which is funding itself, at less than a year, which makes no sense at all, and I don't think any responsible party would do that. So there has to be eventually a shift in duration issuance. Will it be quick? Possibly. A new Treasury Secretary could say, what Yellen has been doing is wrong, and let's go back to, 25%. And that would have an immediate and very quick impact on long bond yields. And the thing that nobody's really discussed is, if economic activity and inflation pick up as a result of these policies, why should the current Fed policy stay unchanged? To me, it's unlikely that that happens. I think the Fed is going to have a much more hawkish stance than it does at the moment. The idea that we can cut rates to 3.5% terminal when tariffs are increasing the price level, deregulation is goosing the economy, and NGDP is over 5%, it's unlikely. So all the dangers are for the bond market to take things not well. Well, very little actually happened last week, but having examined the dangers, I think you will understand why I think that all the dangers are to the upside in yields eventually. And actually a steepening of the yield curve. I just can't see any long-term alternative to that happening. If you have a look at what's happening around the world, last week we had the ECB cutting, this week we will have the Bank of Canada cutting. The central banks have convinced themselves that policy currently is restrictive. And even after the cuts that we've had so far, they're convinced they're still restrictive. Now, whether we believe that they're restrictive is not or not is really not the point. The point is that they're telling us that they think that they are restrictive. So they will continue the cutting cycle whenever that the market allows them to cut. In the US, the market is not allowing them to cut because every piece of economic data that comes out, and all we had last week really was retail sales, is stronger than expected. So the economic surprises are constantly surprising to the upside as opposed to the downside like in Europe and in some other parts of the world. Can that continue? Well, certainly can continue for a while, and certainly if Trump wins and deregulates and cuts taxes. So I think the US has the least downside, and that is being reflected in what is going on. The 2-year did nothing, the 10-year did nothing, the 30-year did nothing. But if one looks at the yield curve, it's just already, right? I mean, it's just ranging, and the moment that Trump gets elected, or even beforehand, it can easily break down. And I've showed you the weekly, the long-term chart before. If this starts breaking down, it can go a long way. It can go all the way down to 75. That would be, to me, the logical response to a Republican sweep. It's important to differentiate between just Trump winning the presidential election and a Republican sweep. The more the Republicans win and the more Trump can actually do all by himself, he can certainly do the tariffs because that's his prerogative. But the tax cuts and deregulation and stuff like that, it's going to take the cooperation of Congress. So the way I would put it is that the more control Trump has and the quicker he can enact policy, the more the yield curve will steepen initially. Certainly, there's going to be, at the very least, a parallel shift. I just don't understand why anybody would want to be long of duration. All the dangers are to the upside. The danger of more issuance, the danger of more inflation, the danger of a Federal Reserve which changes stance. Now, I think it's going to take a long time for the Federal Reserve to change its stance because there's going to be a political battle in Washington, and that is never good for duration. So the first move I really expect to be one of steepening and at the very least a shift in the curve to higher rates. Being long of duration, what can you make? You can make 20, 30 basis points, but you can lose a hell of a lot because this market could really power ahead very, very quickly on a Republican sweep. And that is why you're getting this price action in the differentials between US 10s and Germany 10s. I think the market is going to await the election somewhere up here, somewhere between 190 and 202. It just makes sense. There is absolutely no reason that I can see to be long of the US because the dangers are just just too great. If anything, I'd be long of straddles, because there will be a big move after the election. To me, it's likely to be up in yield, but equally, there's a surprise. It could be down in yield because the US would definitely move on a rebalancing of this spread. This spread would come back down towards 172, so you'd have, at least a 20 basis point move in the 10-year US as this comes back down. Does the market know which way the country is going to vote? No, but people are beginning to place their bets and putting their money where their mouth is. And they're obviously inclined to bet more on a Republican sweep than a continuation of the status quo. What is very, very unlikely is a blue sweep. So that is why it's unlikely that the market is really going to start pricing in anything but the extreme case, because the extreme case is the one that's really damaging to the bond market, and the bond market really does have to price in some level of danger that it goes 50, 70, 100 basis points after the election, because there's a deluge of people who need to hedge their exposure. Well, what has the ECB rate cut done? Well, all it's really done is steepen the yield curve and made periphery bonds more attractive where the carry is the best or the least bad, and you lose the least money. So this is now the Italian bonds against Germany, and as you can see, we are probably going down towards the 100 level simply because of the carry argument. There is really nothing which is particularly attractive about Italian bonds other than the fact that you lose less money by funding them than you do in Germany. And what's interesting is that the 30-year in Germany is absolutely stuck, just like the 30-year in the US. All the dangers are that eventually everything breaks higher as the current situation changes in Europe as well as in the US. And to me, the issuance argument is going to be really paramount over the course of the next 5 years. Governments are just going to have to issue more longer term. The fact that the issuance is so much greater in the US at the moment makes it paramount for the US far quicker than Europe to issue to issue longer term. But I think that pressure is going to extend to Europe as well. Eventually, Europe is going to have to start issuing much, much more at the long end. So I just don't see any alternative for quite some time to a continued steepening of the yield curve, both in the US and in Europe. The dollar stopped exactly where I thought it would, 103.75, and has basically come back a little bit. I don't think it goes very far to the downside. I think, 103.20 or 102.80 is going to cap it, because all the pressure is still going to be for the differentials to go out for the time being. 10s, US, Germany are going to go to, nearer 2 ahead of the election, and then price in whatever happens afterwards. Trump is good for the dollar. Tariffs are good for the dollar. It's unlikely to go down very far. I think a period like this, trading between 103.80 and 103.20, is good for it, and then another leg higher after a Trump victory. That's, I think, what the market is going to price in. What I don't think the market is going to start pricing in is an immediately higher dollar, simply because there is a danger that the dollar starts devaluing at some stage because Trump wants to keep it weak. I know that his policies don't keep the dollar weak, but he would like a weaker dollar. So it's tough to work out how he's going to achieve that, but the market might be afraid of that. So I think the response of the dollar itself for the time being is going to be less than the differentials would imply. So if you think that rates in the US are going higher, bet on the rates, don't bet on the dollar. Gold is just a beast and it's doing nothing wrong. And as I've been saying for a couple of weeks, it comes back to exactly where it should come back to, retracement to 26, 10, 30, stops right there and goes and makes new highs. This monthly chart is as bullish gets. We are in a trend and there is very little to be said about it. If you don't have any gold in your portfolio, you've got to have some. And if it comes back $100, it comes back $100. You buy some more. It just seems that this is a very powerful trend. And the trend could easily be because people are afraid of the Trump policies. They're afraid of eventual devaluation of the dollar. They are afraid of all sorts of things that probably make no sense right now to be afraid of, but they are afraid. And when they are afraid, they prefer to buy gold rather than anything else. And I think that that is happening. Now, will there be a continued devaluation of the currency? I think almost inevitably. So it's not like you're going to lose a whole load by being long of gold. At the worst case, what's the worst case scenario? You get a quick dump on real rates spiking higher, but people are going to buy that dip for sure. When you see a chart like this, gold over tip, it's quite clear that the market is voting with its feet. Gold TLT, new highs. Even gold over SPY is keeping, it's in the middle of its range. So gold is not performing badly even against equities. And it's quite obvious to me that the market is voting and it's fearful. I think there's very little chance that gold is going to come back before the election, and every chance that the dip after the election, the relief, is going to get bought even harder. DBC is just lifeless. It's right in the middle of the yearly range. It's doing absolutely nothing. I keep on saying 2175. That's where you've got to bite for a bounce, and that's about it. We have a little gap down to 2167. I think this area is a very good area to buy it, between 2169 and 2175, but you're buying it for a bounce. When you have a look at what oil is doing and the way oil looks, it just looks sick. It just has absolutely zero strength above 75. 75 is a ceiling for the time being, and 64, 65 I think is going to be a very good floor for it for another bounce towards 75. But it certainly does not look like it's impulsive. It certainly does not look like it's about to make an immediate move higher. And even Trump would not be bullish for oil because it would mean more supply because people would drill more, I guess. So very little attractiveness in commodities at the moment, and that is why I reckon people are just moving out of commodities and into gold. And this is the chart. Every time it dips, there are buyers. It just a chart which will continue to go higher, and we are probably going to go to this kind of level. So you're talking another 10% plus move in DBC against gold, favoring gold. Well, equities are trading absolutely to the tick perfect on the weekly Bollinger Bands, which they tend to do in periods when they are just in a general trend. There is no reason to sell equities. There's every reason to buy equities over bonds because that is the trend. That is where the money is going, out of bonds into equities. Equities are a better hedge for what the market fears, i.e. some inflation from the tariffs, more issuance because of the tax cuts that I discussed, and that all tends to shift the marginal dollar from investing in bonds to investing in equities. These Bollinger Bands are going up to about 50 ticks per week. So next week we're looking at a resistance which, let's hope, doesn't get broken, around 59.10 in SPX. And that's what you're getting. You're getting this wedging, which at some stage gets broken. Probably, it gets broken to the downside, but people buy the hell out of it again. What will the market do on a victory by Kamala Harris? Well, it's going to come back, but why would it go a million miles? That's the thing I don't understand. Why are people buying puts, far out of the money puts to hedge? Is the economy going to go bad immediately because Kamala Harris continues with the policies of Biden? No. It's just all the money that's been betting on Trump is going to get stopped out. And I guess that is this money, the money that is betting above 56.47. Okay, so the market comes back and say it comes back to 5,200. But it's not going to go much beyond there. It just doesn't make any sense that people would sell equities far below 5,200, 5,400. I just don't understand why. This is a great economy. The economy is going gangbusters. And moreover, I think that the bond market would prefer a Kamala Harris victory, and therefore the rally in the long bonds would actually support equities. So all you're going to get in the equity market, should Kamala Harris win, is a stop out of these 4 weeks, 5 weeks that we've had here, and the market may be touching down towards 5,400, maybe 5,300, and then a great big bounce. EEM is holding 45.04, which I think is very, very important. I think another few weeks of holding that support, and then we're going to do one of these. So 45.04, 45.04 doesn't go below it. It can really spike into year end towards 50, and that's a 10-15% move. That wouldn't surprise me at all. And if we have a look at what stocks is doing, that also wouldn't surprise me at all. If it just holds in, every month it closes above 48.50, and then boom, we get a move to 5,300, 5,400. That's, what's that, 7-8% towards the end of the year. That would not surprise me at all. It seems to me that equities are just range trading, waiting for a moment to break out of the ranges to the upside. I just don't see anything bearish on the horizon for equities as an asset class. I see them more, they protect you against inflation more than bonds do at these yields. And it seems to me that the market has decided that it wants to invest the marginal dollar in equities rather than bonds. As next week has very, very little data, it's unlikely that we make any big moves, but certainly the trend should be towards one of steeper curves and higher rates. It just makes no sense that the market is going to price in anything but that. And as I've been telling you throughout, it's going to be the equity market where you're going to make the returns, even if it's a Kamala Harris victory, because then you just buy them cheaper as opposed to anything else. So to me, there is no alternative at the moment to equities, because I really don't see that there is any danger that anyone's policies are going to collapse the economy. I think the danger is to the upside, that the policies that are enacted after the election are actually going to expand the economy, expand economic activity, accelerate it, increase the deficit, and increase the duration of the issuance. So if all those things happen, of course, equities will go up less because they're going to be held back by the bond yields, but they're a much better hedge than bond yields. Bond yields are just going to get crushed. That is the danger into and after the election. Thank you very much indeed, and tweet you tomorrow.